July 15th is that extended deadline, a benefit for taxpayers and tax preparers alike, allowing them a little bit of extra time to gather documents during the inconveniences of quarantine and the uncertainty of the pandemic. Individual retirement accounts, or IRAs, see an influx in contributions weeks prior to annual tax filings. Jay Wild, a principal at Allen C. Young and Associates, says the added contribution is a way to reduce your tax bill. The annual limit is up to $6,000 and an extra grand for people over 50.
So with the IRAs, that is really the one thing that has the biggest impact on the 2019 taxes, is by moving the deadline from April 15th to July 15th. It also allows for an IRA contribution to be made up through July 15th that can be applied to 2019.
And because of the Federal CARES Act, if you've taken out retirement loans or a 401k withdrawal for adverse financial consequences because of COVID-19, you won't be penalized.
If unfortunately you have a family member who's been affected by COVID-19, or if you've been laid off and you've experienced some difficulties financially, I mean, it's going to be a very broad definition that they provide. So in the first place, you will not have to pay that 10% penalty. Then additionally, if you are able to repay that to your retirement account within 3 years, there will be no tax at all on that money.
More good news, that stimulus check you received isn't taxable income. However, if you drew unemployment as well as the $600 per week federal bonus, those are, for 2020, of course. Also, Wild points out that if you owe money, you have to pay by July 15th to avoid a penalty. Darren Cunningham, 7 Action News.